Hello, welcome to another edition of Wealth Transparency. We have two of my favorite people in the industry as guests today. We have Michelle Connell with Portia Capital Management out of Fort Worth, and we have Andrew Tang, who's the Chief Investment Officer at Turner Financial Group. Each week, we try to find headlines that don't make it necessarily into the front pages of every news story, but these are things that impact your portfolio, and we try to dig in deep to discuss them. So thanks for joining me today, Michelle and Andrew.
Thanks for having me.
Thanks.
So let's take a look at real estate, because real estate, even though it's not part of the public markets except for a real estate investment trust, they have a major impact on the wealth building in this country. And there seems to be a lot of stress on loans, commercial loans around the country. Michelle, can you take us through a little bit about what you're seeing in the commercial real estate loan stress market?
Well, when we're looking at delinquencies on those loans, overall commercial real estate, it's not too bad at 4%. But when you break it apart by category, office delinquencies are at 11%. And the reason is that people aren't going to work. We still have a lot of remote workers. And also the higher interest costs are really hurting the owners of these buildings. So that seems to be the issue. And I think from what I read, it's not as bad as 8 yet, but it bears watching.
And what percentage of real estate loans are coming due in the next couple of years? I heard that it was close to 25%. Andrew, can you address that?
Yeah, it's still more than $1 trillion that's outstanding. I don't have the exact percentages, somewhere around, I think, 20% or so. But the areas that are hitting the hardest are the operators and the companies that are developing. So you can see projects halted because they couldn't get refinancing in a favorable term, and that can dramatically affect the company. And a lot of those development companies that go belly up or completely loses investors' money. This is a really sad scenario. It doesn't seem to hit the street because it is not a widespread contagion stage at this point. But at the same time, at the higher rates, it just forces businesses tremendous challenge to continue the operations. You also have inflation in raw materials, labor, and when you add all those together, it is very difficult for development company to finish their projects. And then you have a consumer market that dictates how much rent that they'll pay, so that the return on investments for their income in the real estate projects, it's really struggling.
So is this going to find its way into the banks and hurting the banks and their returns?
At this time, I don't think so, because this is still representing a small percentage of the overall loans that are outstanding. And we don't have a glut at the moment. This is not the same as 2008. 2008, we overbuilt. Now it's completely reversed. We have housing shortages almost everywhere. So builders are getting more and more cautious, and this was started from 10 years ago. And so going to today's time, they're not going to take down materials. They're not going to build any houses and then wait for somebody to buy it afterwards. It just doesn't happen this way. It's a lot more demand driven. And so therefore, I don't think that it's going to be a contagion situation here.
So that kind of plays into inflation, and insurance seems to be the number one factor with inflation right now. Insurance premiums are going up tremendously. We just redid our health insurance here, and it was up 25%. And that's not just because I'm unhealthy. And it's really become a huge problem. And you're seeing it become much more difficult for companies to make as much money because they have to pay out so much more in insurance. Michelle, can you address that issue?
I was kind of looking at it from policies for homeowners and property owners, because those, especially if you're in a part of the country that gets a lot of storms and rough weather, like Florida, Louisiana, and Texas, those premiums have gone up, if you're storm-related area, 40% or more. And so you have to keep in mind that for most mortgages, you have to cover at least 80% of the value of the property. And when you're passing that along to homeowners, especially who are barely getting by, and you have these huge premiums now being put upon them, a lot of them are looking at relocation. And I can tell you, as somebody who manages money for a city outside of New Orleans, they're seeing people leave and put their homes for sale because of the insurance costs.
That's so counter to what you believe, that insurance wouldn't be, that much of a hindrance, but obviously it is. Andrew, do you want to address that?
Yeah, and I'll take the other part of it is that health insurance costs continue to go up. It's just that it's too many parties into the pot. And so you have the middle management company, you have the benefit managers that are dictating the prices that are going to be charged to insurance companies. And then you have an amazing continuation that are really nonstop in terms of inflation for medical services. And then on top of all that, you have a lot of fraud, waste and abuse among the healthcare industry. And so all that you add together, it's very difficult for insurance company to be profitable and to be more efficient. However, there is good news out there. And obviously it has to do with tech and innovation. Once again, many people probably sick of hearing it, but artificial intelligence are working its way into the risk assessment and to be able to efficiently discover fraud, waste, and abuse. So underwriting process used to be a very cumbersome manual labor process. Now it can be done with the help of artificial intelligence, and that can be done very efficiently. So over time, I do see light at the end of the tunnel, but it just can't happen soon enough. And also, it's going to require government support, in order for all this to improve efficiency.
Well, that brings me to the next subject, and it has to do with local governments facing a budget squeeze. State and local governments are losing pandemic-era federal support while facing uneven sales, property, and income tax trends. Some of this is political, some of this is just pure economics. But Michelle, why don't you take us through the squeeze, because our police and our fire depend on federal budgets, and our federal budget depends on other countries because we borrow so much money. So China, in a strange way, and Japan are backing and basically paying for our police and firemen.
And I'd also add on that education.
Yeah.
So it's, those areas, those critical needs of a community. And again, I'm going to go back to the city that I manage their foundation. It's not the city's foundation, it's a private foundation. That foundation, because of the declining tax revenues, now supports 9 schools and the community college and the police and fire department. And I met with the fire department and they said they would not be able to operate if it wasn't for the charities, local charities, pooling their funds and adding to what they need to run a fire department. That's ridiculous. So it's easy now. It's easier for in the cities, but when you're looking at these smaller communities in rural America, they're really being hit hard, and that's why I'm using that example.
Yeah, it's amazing. If anybody took the time to really dissect the balance sheet of not just our federal government, but our state and local governments, they would be horrified to know how tenuous the relationship is and how much money we need. And when people are out, doing fundraising, they really need that money or they're going to have to shut down.
Yeah.
It's a real problem, which then brings me to the federal interest expense is eating the budget. The CBO projects a 1.9 trillion federal deficit, not debt, but deficit in 2026, and then rising to 3.1 trillion by 2036. That's 3 times what Elon Musk is going to be worth after today. But
maybe by then, though, Ed, he may be worth 3 trillion.
Maybe. We'll see. But think about that we bring in about $6 trillion, maybe $5.5 trillion in tax revenue. And we spend just on interest alone almost $2 trillion a year. I mean, again, going back to dissecting the balance sheet of our country, this then puts a tremendous amount of pressure when we go to borrow money. We have to come up with a really good reason for people, for other countries to borrow money from us. And right now it's that we can print more money. So that's inflationary. So we're really in a real, pickle here.
Yeah, it's not getting brighter soon until we can really control our spending. When it comes to pension underfunded, that really has two areas of I see, because many of those pensions, they are not invested properly. How come these pensions can only invest in fixed income? And meanwhile, fixed income are not giving you the return to begin with. And then you have a continuous rise of cost of living, and it's just programs that are not efficiently run, in my opinion. And so the federal debt, it's very close to, in my projection, that by August this year, it's going to hit 40 trillion. We pay roughly about 1.2 trillion in interest alone. So that's about 20% of it. And so going forward, we could grow out of this debt problem by increasing the tax receipts. But at the end of the day, we need to have a government that spends less and be more efficient. And again, sovereign AI is supposed to solve that. But again, it will take time for that to happen.
What do you mean by sovereign AI?
Sovereign AI, it's what Jensen Huang has talked about in terms of the multiple stages of growth wave of artificial intelligence affecting the overall market and society. And sovereign AI is when the governments around the world starts to adapt AI to improve the lifestyle of their citizens. And so in terms of social program, in terms of public infrastructure, using artificial intelligence to enhance the efficiency of doing things.
Michelle, you want to address the federal deficit?
Well, the more we spend, the higher the interest rates that may come upon us as well, because we're getting lower credit ratings. We have more need for money. And in order to attract buyers of our credit, we're going to have to pay more. And we're seeing that anyway right now with interest rates, bubbling up around the world. So I would expect our interest expense to stay where it is or go higher, as Andrew alluded to, unless we do something to really evaluate the expenses. And maybe AI can go in and help with that too, and make what we spend more efficient and not redundant, hopefully.
So consumer credit delinquencies, we talked about this the last couple of weeks, but it continues to soar. And we're seeing more and more people get into credit card debt. And the interest rates on credit card debt is really, really high. And almost to the point where if you just make the minimum payment, it'll take you roughly 50 years to pay off some of the interest that you owe. So, how much of a strain is that, Andrew, on the economy, of the delinquencies?
Yeah, it reflects the stress among the consumer for sure. And we monitor the revolving credit, because whenever household gets into trouble, the first thing they turn to is credit card, and that's the revolving credit. And we monitor that, and we see that the savings rate has gone down, the revolving credit has gone up, auto loan delinquencies has gone up. So this reflects the households are stressed. Consumer loan delinquency also provide a broader picture, and that typically is less than 2%, for example. But once it ticks up, it really shows that households, especially in the lower income bracket, they are more dependent on loans than most households, right? Than the rest of the economy. And that's why it really revolves on the Fed raising interest rates or not. It's going to be really important. And I have to say, for example, a policy mistake will be raising interest rates because of inflation due to higher oil prices. Because high oil prices is a raw material as part of the solution into producing a product. And that also acts as a tax on consumers. So if you add or increase rates because of this type of inflation, you're making a huge mistake. And I think Europe has done that in the past, and we're seeing the terrible results of it. And so that's why it's really important for the Fed to keep the rates low so that the economy can continue to chuck along. Otherwise, to create a restrictive environment is to really strangle the lower income part of the economy.
Yeah,
and that's why it's really important.
And I've been saying for many, many years what a big problem our national debt is. just the interest that we pay on it alone, and then just our deficit. And remember, deficit is what we're short every year. Debt is what we owe long term. So for those of you watching, remember that the deficit is what you're asking your local, your congressmen and senators to give from the federal budget for new roads and bridges, which we have a terrible infrastructure problem in this country.
So the Congressional Budget Office, the CBO, that's the official department that handles the budget. They projected this year it's going to be about 1.9 trillion. It's high as ever. So it seems that we are continuing to top off. Each year we have a higher deficit. And it's really bad because we could enter into a debt spiral to get out of control. And then if there's any kind of a backward, or if we lose the strong demand for U.S. Treasuries, that's what you were alluding to, Ed. If we have any kind of a pullback in the demand for U.S. Treasuries, you're going to see the yields go up. And that's why we monitor the yield so much, because it is a indirect way of monitoring the demand for treasuries.
I've often thought about a movie about if the head of China and the head of Japan got together and decided not to buy any U.S. debt, what would happen to the world? It would be an incredibly, terrible thing. And I feel like we're in the simmering point, just like when we had the mortgage crisis, there were some, kind of little notes about, is there going to be a mortgage crisis? And then there was. I feel as though this is the beginning of a debt crisis. And I just think that we're going to look back at this podcast years from now and remember that when we were talking about this, how realistic it came to be, because I really do believe that we're in our beginning stages of a fiscal crisis.
May I add one more thing?
Sure.
This is already happening. So we can see that the BRIC Alliance is already doing that. So behind the scenes, China, it's been trying so hard to court and to nurture many emerging economies and try to court them into settling for petrodollars and also global trades outside of US dollars. Okay. Among themselves, the BRIC countries, the Brazil, Russia, India, and China, and now they added Saudi Arabia, right? So this alliance among themselves, they already trade outside of US dollars, okay? And on top of that, we also have the digital currency. We have Bitcoin, and many of the trades, they do settle in Bitcoin because if they don't want to use US dollars. So going forward, this poses a threat. And that's why at the same time, it's my belief from the reports that I have seen that the U.S. is trying to promote stablecoin so that it will settle instantaneously. It doesn't have to wait a couple of days. And it's a digital on-chain item, and then it's backed by the Treasury. So if the U.S. can successfully promote stablecoin, USDT and USTC, then the U.S. will continue reign supreme on its demand for its debt and let the world finance its debt. So that's where we're at. And then mark this.
So Michelle, let's turn to AI data centers and turning electricity into an economic bottleneck. We continue to hear the need for data centers, but I don't think anybody has ever really looked at the addressable market and know exactly what the total addressable market is for data centers because they continue to grow. What do you think about the amount of money going into data centers?
I don't think that it's going to decrease. Actually, I think that the amount of data centers will double in a short period of time, probably within the next 18 to 24 months from what I've read. But it's what you're starting to see, though, is pushback in communities and states saying, we don't want it here, and I haven't looked closely at what it's like to live near a data center. I've heard it's not pleasant. People say they're very noisy, etc. But some builders of data centers are trying to offset the nuisance and the pushback by paying communities to have the data centers in their areas. I just heard today, don't know what parish or county in Louisiana, but data centers that were built there are paying the teachers a bonus of $50,000 this year so that they can have their data centers in that community. Let me tell you, $50,000 is a lot of money in Louisiana. That's below the average salary in that area. I'd have to look at the county. It may be even double, but $50,000 bonus so that we can do business in your community. I think find that very interesting.
That's amazing. The numbers we're talking about these days.
Yeah.
I mean, 50,000 is probably double what they're making in their salary.
As a teacher in Louisiana, probably.
So the last subject matter today is the real cost of home ownership is outrunning the mortgage payment. I mean, is it worth buying a house these days?
Yeah, you want me to take that?
Yes, please, Andrew.
Yeah, I still believe being a property owner is good. Unfortunately, the rise of home ownership has pushed back the average age of a first-time home buyer to 40 right now. I think I've said that many times, and that's really, really sad. For a new couple wanting to start a home and basically live the American dream, right? Unfortunately, property taxes continue to climb. I think what you alluded to also, insurance costs are constantly going up. Utility costs has been going up, especially for electricity and water. So it's becoming less and less affordable. Building material, labor, in the old days, you can probably, build a deck in your backyard for about $10,000. Now it's at least double that, for any decent deck out there. And so the affordability issue in housing, it really is putting a dent into home ownership, unfortunately. But I still believe it is the way to go, because when you're paying rent, this is my personal opinion, when you're paying rent, you're paying somebody's mortgages.
That's a good point.
Yeah.
Michelle?
I would like to add on to that. When I did some research, tax and maintenance for the average homeowner now is $16,000 to $24,000 a year. That may not be a lot to an upper middle class or ultra wealthy person, but to a middle class person, like Andrew's talking about, an average home buyer, and you're trying to get in just to qualify for your mortgage, and you're like, okay, I got in, I'm going to get that home, I can afford the mortgage. But then you have another maybe $24,000 in costs that you have to budget in. That makes things even tougher for people to get in and be a home buyer.
Yeah, my daughter and her husband, can't believe she's married, but they're about to have a child, and they're looking at houses, and we're going through cost analysis, and it just doesn't make a lot of sense. They're renting right now, and I keep encouraging them to rent, even though it makes, economic sense to buy, but I'm going to have to come out of pocket for the down payment. So maybe that's why I'm skirting it a little bit. But
Yeah,
you make an excellent point.
Yeah, Ed, congratulations, first and foremost. I'm going to take the other side of the discussion here about AI data center, because this is where data centers can actually help, because AI data centers belong in the commercial real estate space. So they can actually help in this effort, in this subsector within real estate. And then you also don't see and don't understand and not really talked about is that when AI data center is up and running, they offset a tremendous amount in property taxes for that zip code, okay? So that is a hidden gem for houses that are, basically around the data center. They offset a lot of the property taxes. And at this stage, AI data centers, they're not going to be approved unless they can secure their way of providing power. And then this water issue is really not an issue. It's just not true, that they use a lot of water. They don't. And so that's why I think if people could further research about this topic, I think AI data center can live in harmony with communities.
So you're telling me that when a data center goes in, it will replace the need to tax the homeowner?
No, not 100%, but they will reduce the property taxes. They will reduce the tax base.
Interesting.
Yeah. Mm-hmm.
So as we do every week at the close, I ask you for your stock based on these news stories. And so Michelle, why don't you take it away?
And I still like tech. I mean, we've had a pretty good pullback in the last week or so. And so I'd be picking up the names which are necessary for the AI build out, because I still like that area. I'd stay away from the tech companies that are taking on more and more debt so that they can have their infrastructure build out. But I do the picks and shovels, still like semis, still like Dell, still like utilities, the things that we need to build out the AI infrastructure.
Okay. Andrew, what about you?
Well, what I'm going to say is that today is the debut of SPCX ticker symbol, SpaceX, and they're looking to open at $175 a share. IPO is at $135. When the valuation hits the secondary market for SpaceX, it is my opinion that it is advantageous to buy Tesla at this time, because ultimately these two companies will merge, and Tesla right now is grossly undervalued for its robotaxi, its AI, and robotics line of business. And I talked to you about this before, that this belonging into the strategic tech sector. Looking at the progress of Tesla, they have made tremendous progress, even though the revenue doesn't show it yet. By the way, there are multiple upgrades of the company because Tesla is officially able to achieve level 4, okay, in the state of Texas. They are officially level 4 autonomous driving. And so it is the matter of time for this revenue that's coming into this robotaxi space to reflect on their balance sheets and their valuation. And so at today's prices, I still think it is very undervalued. And if these two mega companies are going to merge, right now I would sell the fairly value and then buy the undervalue if I know that these two entities are going to merge somewhere between 1 to 2 years.
So
This is not investment advice, by the way.
I rarely give my opinion, but I've recently become a big fan of Rivian. The R2 is
Okay.
their new generation. And if they're able to knock it off, just basically knock it out of the park, that stock is going to go a lot higher. It's not expensive. It's about $57,000, and it's a really great car, the R2, and they're putting a lot of emphasis behind it. Never been a fan of electric vehicles, but recently I've become a lot more of one due to my kids encouraging me. And so I'm looking at that and like it quite a bit. So I'd like to thank both of you. Michelle Connell with Portia Capital Management in Fort Worth. Please reach out to her if you have any needs on your financial situation. And Andrew Tang, Chief Investment Officer with Turner Financial. Thank you very much to both of you.
Thanks, Ed.
Thanks, Ed.